Money is one of the essential things in our lives, yet it's one of the most mysterious. How does it work? Why do some people have more than others? Most people think that getting rich is impossible, but what if I told you that it's not only possible but more straightforward than you think? In this video, we'll look at how money works and explore ideas about managing your finances. So please stay tuned and let's dive into today's topic, how money works. Hi, my name is Sunny and I make content that affect a common man financially. If you are new to this channel, please subscribe to it alongside smashing that like button as that will help me with the YouTube algorithm, which of course will be highly appreciated. Money is a tool that people use to exchange goods and services, which means that people can save money and use it later on to buy things. There are different types of money, such as paper, coins, or credit, which can be used for buying things, investing, or even saving. The most common types of money in the world is fiat money, which is not backed by any physical assets like gold or silver. The value of it is solely based on people's trust. The US dollar is a perfect such example. Banking is an industry that has been around for centuries, and the way they create money, however, is something that has changed and evolved over time. Today, banks create money through fractional reserve banking, where a bank holds on to a portion of the deposits made by customers and loans out the rest. Hence, the bank can loan more than it has, thereby creating new money, which enters into circulation and becomes a part of the economy, thus increasing the money supply. But don't get me wrong, it is, however, inherently risky. When banks are required to hold only a fraction of their deposits on hand, they are vulnerable to a run on the bank. In such a situation, many customers try to take their money out of the bank all at once, which can cause a bank run as it does not have enough capital on hand to meet the demand for withdrawals. Thereby, bank could possibly collapse, taking the economy with it. The same thing happened in 2008 when financial institutions were collapsing in a domino effect. Inflation is the rate at which prices of goods and services rise, eroding the purchasing power of money and directly impacting your standard of living. Factors include excess money supply, increased demand for goods and services, and production bottlenecks. While a small amount of inflation is often considered beneficial for an economy, too much of it could lead to economic instability and a recession. The world has been experiencing a period of low inflation since the early 1990s. On the other hand, deflation is decrease in general price levels of goods and services that causes consumers to postpone purchases, since theoretically now they should be cheaper in the future. It generally leads to a fall in demand that could possibly lead to an economic recession. The most significant deflationary period in US history occurred during Great Depression of 1930s, when prices fell by more than 25%. The US Federal Reserve has a significant role in increasing or decreasing the money supply through open market operations, which affects interest rates, inflation, and economic growth. They can reduce the money supply by increasing its benchmark rate to cool down an overheated economy. Such activity will increase the borrowing cost for all of us, thus reducing inflation and slowing down economic growth. But Fed can also increase the money supply simply by purchasing government securities through open market operations. It can reduce interest rates, that reduces cost of borrowing and increases economic activity that could lead to high inflation. That is precisely what we are seeing these days, the culprit being pandemic, when the Fed had a loose monetary policy as it was trying to give support to the economy. To save money for the future, be aware of inflation and how it can impact your finances, thus ensuring that your savings will be there when you need them. Try to focus on investing in assets that tend to hold their value over time. Safe idea could be having a diversified portfolio to minimize exposure to changes in any particular market. And finally, Stay informed about inflationary trends so that you can adjust your budget and saving goals if the need be. I know saving money for future can seem daunting, especially if you have a tight budget. However, some of the few strategies that can help offset any implications are: automate your savings, make a budget and stick to it, get in the habit of saving for significant investments that can be your house or a car, pay yourself first, learn about tax codes so that you can avail allowed deductions or any write offs, and finally save and invest for retirement. But that is me, I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not a financial advisor, so please consult one before investing based on your financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.